What's up, guys? Ron from Rohde Law, and today we have a really exciting speaker. It's Chad Griffiths. He is a commercial real estate industrial investor based up north in Canada. But we're going to talk about his first investment deal, how he got started, how he got the money, how he sourced the deal, everything. And then finally, we're going to learn about his long-term outlook and his goals as an industrial investor. So what's up, guys? Ron back here with this part 3 of the amazing interview with Chad Griffiths. It has been real fun to listen to him as he walks through his first industrial triple net purchase. We're going to talk about the lease structure that he had on that first deal, how he navigated it, and then what his goals are for the future. I think just step 1 is a part of it, but industrial investing really allows you that opportunity to scale. So tune into this video to find out what Chad's plan for his investment portfolio are going to be. Another topic that comes up for me a lot is what was their initial lease structure?
This, in my mind, is one of the most beautiful things about industrial real estate. And you could even say more broadly commercial real estate, because a lot of leases triple net structure. And that's why you need a lawyer. Like you know that I'm a strong advocate of anybody that's investing in real estate in any capacity needs to have a lawyer, as opposed to just going onto Google or Chat GPT and saying, I make me a commercial lease for Texas. You need to actually have a lawyer on this, because I'll defer back to that as the overarching comment on this is everything depends on what the lease says. So whether you have a lawyer reviewing it or you have a lawyer creating it, what the lease says is what's going to essentially govern that relationship between the tenant and the landlord. So in a perfect world, and every property that I own and every property that I would want to own is going to be structured in this triple net basis. And at a high level, it gets broken down into two different rent streams. The first gets called net rent or base rent. It can be called any number of things. It varies across different markets, but that is a predetermined rent that the tenant is going to pay the landlord for the use of the space. And it can be a flat rate. It's usually quoted in per square foot. Houston quotes it per square foot per month. Everywhere else that I know of quotes it per square foot per annum. Houston's a little different. They do things a bit different, hey? Everything else is per square foot per annum. So let's say you see something at $10 a square foot. That whatever that number is, that's what's going to be agreed upon for the whole term of the lease. It could be $10 a square foot flat, can be $10 a square foot with 2.5% yearly escalations, can be $10 a square foot with 25 cents a square foot yearly escalations. That number is agreed to. The other component of the rent is that's the operating level expenses of the property. And the easiest way to explain it is if it's a single tenant in there. So if there's the property taxes, the building insurance, common area maintenance, management fees, all the things that are required to keep that building operational, that's considered the operating costs. And for a true triple net lease, those expenses are estimated at the beginning of the year. The landlord will create a budget on what they think that those costs will be. They'll charge the tenant incrementally, usually monthly, to pay those operating level expenses of the building. At the end of the year, after they've reconciled all their bills, they'll either provide the tenant a credit if they charge them too much based on their budget, or they'll invoice them for any deficiency for what they didn't charge enough for. And those numbers are floating. That's just an estimate that they're preparing on each year, and it will vary. It usually goes up because property taxes usually go up, insurance usually goes up. But the reason that we do that, and the reason as an investor I want that, is if I had a gross lease where all of that was included in one single monthly sum, if property taxes go up 15% next year, and I'm not allowed to flow those increases through to the tenant, then I'm essentially eroding the amount of money that I'm either relying on as profit or I'm relying on to pay my debt or whatever it is. If I've got a gross lease, which most residential leases are gross leases, they're 1-year leases typically. If I had signed a 10-year lease and property taxes increase 10-15% a year, by the end of that term, I might not even be making enough money to pay my bills. So the essence of a triple net lease is it protects the landlord from increases beyond their control, and it gives them the comfort of entering into a longer term lease, knowing that they're not going to have to erode the amount of money that's coming in. So that's a look at the lease, have a lawyer that is experienced in commercial real estate, explain that is the intent of the lease. Whatever it's called, additional rent, operating costs, base rent, triple, whatever it's called, it's what does the lease actually stipulate? And most leases that I'm seeing these days, and you look at leases all the time, most industrial leases, especially if it's done between sophisticated parties, will be structured that way.
Back to your first property, what was that lease structure?
They ran their 5-year term. We didn't miss a single rent payment. So I don't want to give them misconception that a welder's a bad tenant, because we have a welder in that space now. But if my memory serves, from 2014, it was $10 a square foot that we were charging them. And then we estimated our operating costs at something like $4 a square foot. And again, that estimate, we had condo fees on there because it was a condo, property taxes, and then we baked in a small management fee as well, just for us having to manage it. And we had that one fixed for 5 years. So $10 a square foot for the whole term.
Wow.
That was 2014, little different times back then. Now it's pretty common. We're seeing a lot of people try to put in 2.5 to 5% yearly escalation pegged to inflation.
Yeah. So your first property that you purchased, it was on a triple net lease, but that didn't intimidate you.
In my mind, that's what enticed me. It wasn't even intimidation. I wouldn't have wanted to do that. Have a 5-year tenant in a space without having the comfort of knowing that profit and the net rent that we need to pay bills, and you want to cash flow on your properties. I wouldn't have been comfortable doing a 5-year lease without that. So it's a kind of a double-edged sword. It can be intimidating. Echo your comments either. The last thing we want to do is scare people off from this. And we start talking about leases and all these intricacies and new terminology. It can scare people. I think that's also what separates and makes industrial an interesting asset class, the fact that it does take work. Whereas
it's a moat. It
really is barrier to entry.
A surmountable moat. And that's what, again, attracts me to it and why I love it. Because so Warren Buffett is the one that comes up with this concept. I don't know if you're referring to that, but he likes businesses that are very good at what they do. They have a very strong brand, but that their business and their revenue and cash flow also has a moat around it. Mm-hmm. And whether that's Coca-Cola, that is just by far the best. Pepsi has been a distant second forever, but mm-hmm. Coca-Cola has that moat around its cash flow, and you can pay for a company like that because it has a moat. Same thing for industrial, except this moat is something that can be overcome. It can be scaled by an investor, by learning, by reading, by watching YouTube and podcasts. At the end of the day, I think you have to enter into a triple net lease. You've got to buy something with a lease, but at least your initial fears can be overcome. And it's not a moat like investing in pre-IPO companies, right? Which is kind of like a boys club, or it's a who knows who, and you have to be a former, VC guy to get into these opportunities. It is not a moat that if you're born in a different country, if you are a different, skin color, it doesn't matter. There's all sorts of backgrounds in industrial, but this triple net keeps out people who are unable or unwilling to learn about something new. And that's what I love about it. So
couldn't agree more. Well said.
All right. Well, this will be the interview where Chad agrees with everything Ron says. All right. Well, we're going to wrap it up. We've had some great conversation. What do you see for your future? I know we're bullish on industrial. I know we're bullish on the north-south railroad, rail line, and nearshoring. I get it, but we're not deploying $500 million. We're not deploying 50, sites to acquire in the next 12 months. What are your goals for your industrial portfolio? 5 years, 10 years? I don't know, longer.
Yeah, and it is something that I think about quite often, even though it's not a big portfolio compared to what larger investors have. It's still my portfolio, and it's still where I do want to drive income and retirement from that down the road. So everything that I own currently is within 20 minutes of where I'm sitting right now. So I'm hyper focused to a point where I've hit how much I want to own in this particular market, and I do want to actually start diversifying out of it. So the portfolio that I have, I really like every property that we have. We've only sold one since we started buying. Everything else we've held, and I look at it as I hope I never have to sell. I would love to keep these in perpetuity, so that at some point it replaces my income from brokerage, and I can move full time into investing. That would be a longer term goal, whether that's 10 years out or shorter, longer. And we need some market luck to some extent on that. But I do want to start moving out of Western Canada. I'm very interested in Texas, as you know. I think that is, I think that is, if I were to put my money anywhere else right now, I'd be looking at Texas. I like the port areas. Corpus Christi is one that I'm particularly interested in. I'm interested in anything that either has port access or will be near the rail line, the CP Kansas City Southern one. Interestingly, I just heard yesterday that decision probably is getting delayed until late February, maybe even early March now. So we thought we'd hear on that approval sooner. It's getting delayed a couple months now. But
it was
I
announced
like.
like 2 years ago. I
Oh, I
mean,
know.
it's
It's just
been a
that
long
process like that
time
is a
making.
long dragged out time. But yeah, I like anything near a port, and I like anything near either an intermodal yard. So things coming in on rail, getting transferred onto semi trucks, anything intermodal yard, anything near an airport. And that's after identifying areas of growth. So I think me personally, the biggest indicator of future opportunity is finding an area that has population growth. I think Texas is going to have that for the foreseeable future. Just much more business friendly environment, not as much red tape. I see Texas doing really well. I like Florida. I like Georgia. Savannah's an interesting market to me right now as well.
I
It's
saw
one
your
that,
tweet that
yeah, I just
they
started
had
looking
as
into that
many
one a little bit more.
huge lease signings as DFW, which as same as Houston too, which blows my mind.
Yeah, and even though like I'm not going to buy a 1 million square foot building, the fact that there's 1 million square foot buildings going there means that the economy is driving other sectors as well. So that someone could go and buy a 20,000 square foot building. If you're located next to a 1 million square foot building, chances are that there's a reason they pick that area. So that's one of the reasons I follow Prologis so much. Is I've previously been a stockholder of that and sold out at the height. I had really good timing on that one, but I
Nice,
still follow
nice.
them regularly because they put out such great information. And if you want to see what goes behind the scenes of a $1.2 billion square foot portfolio, that's a pretty transparent way of getting a look under the hood. So I still follow those large ones, even though I'll never be that investor myself. I love that B class industrial flex space. I like the distribution centers and I track it, but I won't be that investor. I'm just never going to be at that scale.
Yeah, I think it all goes back to knowing yourself and what you want to do. I think you really almost you need to be a I don't say billionaire, but you need to be in the hundreds of millions of net worth to where you're individually or your family office is buying those buildings at scale, because it doesn't make sense. Nobody buys like one class A distribution building. Nobody does.
No.
And unless you're a billionaire who deploys 300 million or something, 200 million of properties with 75 million of your own equity to buy a small portfolio of those, it just doesn't make sense. So I think knowing that as a limiting factor on your goal, which is not monetary and not size at all, but it's just knowing that I'm not going to be buying those types of buildings. It helps eliminate some choices so that your future can be more niched and more focused, because there's plenty of product.
So we do agree on everything. Maybe we should have something controversial for having some entertainment value, and maybe we should have something we disagree with before we wrap up.
All right, what do we disagree on?
Well, you're a Cowboys fan. We could start with football, and then we could talk about the market too, because there's going to be a lot of people reading different tea leaves.
Okay, so you say most of your net worth. Most of my net worth, I would say, is commercial real estate as well. But do you have exposure to the market?
No, because we're hyper focused right in this area.
Okay, so I disagree with that, because I really think, and here's the scenario: you may have partners, but does your spouse trust your real estate partner? In so much that if you die, you get hit by a moose, right, while crossing the highway.
I like the Canadian analogy there. That's appropriate.
We got to play into the stereotypes. Just lean into it, embrace it. But if you get run over by a moose, which moose accidents are very deadly, very dangerous, does your spouse trust your real estate partners to continue managing it for your estate's benefit? Because that to me is the biggest question. And of course, I love my partners. I mean, not my marriage partner, but my real estate guys. I love them. I trust them. I would say that yes, they would mostly do her right, but I still have several hundreds thousands of dollars in 401k, some IRA, self-directed IRA, and I continue to put money into the market because it's a hedge against the real estate not being able to be managed. And that's, I think you would, be better off putting something into the market with a 20-year horizon, just to let it ebb and flow and ultimately grow at 7% a year on average, versus all in real estate. Because what you don't realize is the management part is really tough, and you feel very confident, but what if you're gone? Does your wife know how?
No, and I guess I sort of hedge against that risk from the standpoint that I have a lot of life insurance.
Oh, you
So
do? How much?
I
No, just kidding. Don't say
like
the number.
couple million. I've got like a lot of life insurance.
Okay.
So I would hope that, well, you never even want to think about those situations, but you have to. And I think that I'm protected from that standpoint. And I do have some money that could be liquidated quickly. I say perhaps somewhat facetiously that I've got the majority of my net worth directly in real estate. I do have some liquid funds that, because you always want to have some dry powder on the
Yeah, but if you
sidelines
have
as well.
CDs, or you maybe have T-bills or whatever the equivalent, money market funds, that's fine. I guess I'm talking about like pure equities, stuff that if I died, I would not want to pull it out of the market right now
Yep.
because it's dipped. But yeah, I mean, I still sock away a good amount every year, and I understand, it's handicapping how much I can buy every year, because I'm kind of with you, the one a year. That's been my pace for the last 3 years, and then I've done some other side deals where I'm an LP with my friends. It's still joint ventures, but I'm not the lead, and I'm not the PG on the debt, personal guarantee on the bank loan. So that's maybe something we disagree, because I think traditionally the retirement model for the stock market has been good, and you can't argue with kind of the Warren Buffett, Benjamin Graham, if you're familiar, the intelligent investor.
Yep, I've read it.
Solid fundamentals. I still would rather have 10-15% of my net worth in just regular plain old equities, because I only have a $2 million life insurance. So nobody come after me. If my wife ever watches this video, she should not kill me, because it's only 2 million. You're going to have to manage the real estate and get the other partners to buy you out.
Which might cost 2 million. might just be a wash in the end.
That's right. But yeah, no, it's really an interesting question, because I deal with that kind of estate planning, just kind of high level, like what do you do? And for better for worse, it's like I may have a spreadsheet, or she can look at my tax returns, but fundamentally it's very complicated, and it's hard to unpack if you're not a real estate investor. So
It is very convoluted. I actually want to go through that exercise with my accountant at some point, because just as an example, I have my main company, which functions sort of as a professional corp, and so like an operating co. And then that company owns several holdcos, which in turn own percentages of companies. So there's all these layers of intricacy that my wife would be, she'd hate me even more for than dying would be leaving her, saddling her with that mess. So yeah, it's the insurance money would definitely have to go towards paying like a forensic accountant to just figure out all the different layers on there.
you go. All right, you pick one last topic, because I think we're both Cowboys fans. Do you like Dak? I don't like Dak.
I've been neutral on him. I didn't like Romo though either. I was neutral on Romo. He just never could seem to win in the clutch moments. And I think Dak's kind of like that too. Guess we'll see this weekend
Nice.
if he can.
He's not a killer.
He's not a killer.
It's
No.
exactly the NBA, right? If you have a game-winning shot, you give the ball to Jordan, or do you give it to LeBron? Jordan, 10 times out of 10. You give it to
Every time.
Kobe. Kobe wants to win. He wants
Mhm.
to beat you, and you give him the ball 10 times out of 10, even if LeBron is statistically a better, more athletic, more naturally gifted player. Yeah. All right. So You suggest something. What can we disagree on?
What do you think happens in 2023 for the market?
Which market? Real
Well,
estate?
you could we could be as specific or as broad as you want. Well, let's say this: recession this year, yes or no?
Yeah, I think in hindsight, we will see another little dip of a recession, a technical, statistical recession, but nobody's going to feel that way because a lot of people are still keeping prices up. A lot of businesses feel like they are supply constrained, not demand constrained. And until the demand completely falls off, we won't trigger feelings of a recession. So everybody's going to be this kind of milk toast of like, oh, 12,000 people at Alphabet lost their job. So what? These are all rich people with high incomes that can get another rich job. But
Mhm.
tech has experienced a ton of layoffs. Like statistically, you have to add it up. It is a significant number all across the country, but nobody feels that. Nobody's really scared unless you're in specific industries that have been cyclical anyway, right? So mortgage lending, home builders have completely stopped, right? I think there's a report in DFW's like few hundreds, like 700 new home permits were filed in a month from like 12,000, right?
Wow.
You just dropped off in the region because no home builders want to build. So those contractors are feeling some pain, but they still feel a backlog of renovation jobs because people are still
Mhm.
feeling very rich in equity, home equity. So they tap that home equity line of credit, do some renovations, hire those same contractors that aren't building the new construction subdivision builds. So this feeling of worry or fear is not going to quite take hold, even though there's individual pain. That's my very long answer to what's the market going to do in 2023. It's going to be technical downfalls, but broadly, people will feel it in very different ways.
Yeah, and unfortunately, I agree with you on that as well. I,
Ah,
I, I do have a topic though. I think we could perhaps have some disagreement on cap rates. What do you see cap rates doing this year?
oh, they're definitely going to expand.
So where do you put Dallas, or you could even be more broad and just say Texas right now? Where would you have put it before the interest rates started increasing last year, and where would you put them now?
Uh, I mean, okay, between like multifamily, industrial, and office stuff, you were maybe looking at like an average cap rate, a weighted cap rate of like call it five. I don't know, because multifamily is below it, but office industrial is right around there, five, 5.5. I would say it's going up by a full point, or maybe this is a better answer. The cap rate will be 1 or 2 points above debt costs. And I just saw somebody that their lender fixed them on an industrial deal at 7.
Hmm.
Um, so I would say the cap rates, and again, that wasn't like a high quality asset, but it was occupied with long term tenants on net leasing, and they fixed them at 7. Just kind of just general. The lender doesn't need to lend; they don't feel pressure to lend. So I feel like they priced it. They raised it from LOI. They raised it from pre commitment era,
Hmm.
but they just felt like we don't need to push this money out. We feel like there's risk. We'll loan, but 7. It's
I
like hard
think
money range.
uh,
Yeah.
yeah, that is hard money range. That would have been, yeah, 2 years ago, a year ago, it would have been. I think that's light. I think that we'll probably see 200, 300 basis point increase in
Okay.
cap rates. So if that high quality industrial would have been five, which let's
You
new
think they'll
modern
trade for a
building,
7?
I think that's what it's going to be.
All right. Well,
And those are outliers too, because I don't think that those properties are going to trade, right? Like
that's true.
why
That's
would a
true. They
company
just
sell? They
They
just
won't
won't
sell.
sell.
They don't need to. They're not getting a run on deposits. They're not short on cash. They're not vacant on their other properties that they need to generate debt payments. Um, I 100% agree. That's the same thing we see in the residential market. People sitting on low fixed debt, generally occupied or cash flowing, at least neutral. Um, and if you don't have sellers feeling pressure to sell, yeah, maybe they'd be willing to sell for 5.5 or 6. But if no buyer wants a 5.5 cap, then they're not going to sell. So only the sellers who have a motivation to sell. And this is like sidebar, but another observation or prediction is this is why you always have to keep putting LOIs out. You've got to constantly be testing the market, because in a target portfolio of 30 properties that Chad Griffiths likes to buy in Savannah, Georgia, he's going to put offers on his top 10, and they all turn him down. They all counter at the 5.5. They all counter at 6. And he says, no, I want a 7. I want a 7.5. Of those 30, maybe 3 of them will be individual situations. A partner dies, a partner split up, some situation they want capital to do something else, divorce. You have to find the sellers who are individually motivated to sell. And then when they get that offer, they're going to counter you and they're going to play ball because they want the liquidity. It's not going to be a market-wide pressure on everything pushing up, because I don't think we'll ever get there. We're not going to get 17 vacancies out of the 30 properties that you want to buy and selling, hey, I could go buy this, I could go buy that. How do I know your tenant's good? You need to compensate me for my risk. The sellers just won't sell. They've got low cost fixed term debt. They've got equity in their properties. The transactions that do go through maybe will be at a 7 cap if that's what the buyers want to be compensated, but it's not going to be a flood. It's not going to be 15 of those 30 trading for 7 caps. It's going to be 3 out of the 30. So it's your
and there'll
job.
Be more. There'll be more under the hood too.
Investor, to find them. Everybody who's listening, that's your opportunity to get into a good deal. Because if you tell me, hey, I bought this property at a 7 cap in Savannah, I'm like, good job, good for you. That's awesome. But how'd you find it? Well, I submitted 27 LOIs. 25 of them told me to pound sand or pay me a 5.5 cap. Because I feel that way. I'm less of a never sell guy like you. I'm maybe a little bit more opportunistic if I'm getting good returns. But I have no pressure. I have no inclination. I'm not listed. So you got to make me a developer vertical offer to make me sell. So
agreed. Damn it, we're agreeing on everything.
We'd
have some more tension. That makes good radio.
We need more politics or what are real estate investors' favorite music types? That'll be interesting. That would be interesting because a lot of people like country and they're not even country people, but they're like, yeah, I like country music. I'm like, why are we listening to this? But
we have all kinds of ideas. We might have to start a second channel. Might just have to do it.
And then we can drink whiskey while we do it too. That'll make it interesting.
This has the potential of something big. Awesome.
All right. Well, we've got a wealth of information from Chad. So thanks again for joining. And it was really insightful to learn about how you did your first deal, how you got started in industrial real estate as an investor, as well as your outlook for the future and how you use your industrial portfolio to take control of your life in these turbulent times. So thanks again to Chad. Smash the like button if you haven't already, subscribe, and we'll see you next time.